Hey there, and welcome to today's Explainer. I want you to picture this for just a second. You've finally found it. The absolute perfect house. The one with the huge kitchen, that backyard that is just begging for summer barbecues, and it's right in that neighborhood you've been dreaming about. You are so ready to put in an offer. But then you realize there's a literal three-digit number standing right between you and those front door keys. Now, we all kind of know that credit scores matter, right? But for first-time homebuyers, this number is literally the single most important factor in figuring out if you can actually get a loan and exactly how much it's going to cost you. So, today we're going to break down everything you need to know about credit scores so you can walk into your home buying journey feeling totally confident. Here is a quick roadmap of what we're covering today. First up, credit score basics, followed by the 5 score factors. Then we'll dive into mortgage rates and scores before wrapping things up with strategies to improve scores and some common myths and tips. Let's jump right in.
All right, part 1, credit score basics. Okay, let's just strip away all the fear and that super confusing financial jargon. What actually is a credit score? Well, honestly, the absolute easiest way to think about it is like a financial GPA. Just like your grade point average back in school told a teacher how well you knew the material, your credit score tells a business how likely you are to actually pay back the money you borrow. And why do mortgage lenders care so much about this? It all comes down to one word: risk. Think about it. If a buddy asked to borrow $20, you'd probably think back on whether they've actually paid you back in the past before handing over the cash, right? Mortgage lenders are doing the exact same thing, but instead of $20, they're dealing with hundreds of thousands of dollars. That metric is a 3-digit number, and it typically ranges from 300 up to 850. A higher score acts as a direct reflection of your financial reliability. It basically flashes a big green light to the lender saying you're a low-risk borrower, which makes them feel way more comfortable handing over that loan. Now, you might be wondering, where does this magical number actually come from? Well, your score is calculated using info from your credit reports. These are essentially your financial report cards, and they're managed by 3 major companies: Equifax, Experian, and TransUnion. These 3 agencies track your history with things like credit cards, car loans, and other debts to generate your overarching score. Moving right along to Section 2, the 5 score factors. Okay, let's dive into this. You've probably heard of different scores, like FICO or Vantage Score. These are really just different scoring models that lenders use, but they generally all look at the exact same 5 ingredients to bake your credit cake. So the biggest slice of the pie, coming in at a whopping 35%, is your payment history, basically how you paid your bills on time. This is huge, guys. Even just one single payment that's 30 days late can seriously damage your score. The next biggest ingredient is amounts owed at 30%. Lenders want to see how close you are to your credit limits. If your cards are totally maxed out, it kind of looks like you're over-dependent on debt. Then we've got length of credit history at 15% because older accounts prove you have a longer, more stable track record. And finally, we have 2 10% slices. Credit mix, which just shows you can handle different types of debt, like balancing a credit card and an auto loan at the same time, and new credit, because opening up a bunch of new accounts really fast can make it look like you're panicking financially. So you mix all those ingredients together, and what does the final number actually mean? Let's break down these ranges. If you're sitting at 800 to 850, that's excellent. You're basically a low-risk superstar to them. 740 to 799 is very good, meaning you're still going to have a super easy time getting approved for really great rates. 670 to 739 is good, which most lenders view as a totally acceptable lower-risk range. Now, 580 to 669 is considered fair. In this range, lenders might label you a subprime borrower, which unfortunately makes it harder to get a loan and definitely more expensive. And finally, 300 to 579 is poor. Down here, it becomes incredibly difficult to get a mortgage without taking some serious steps to improve your score first. Which brings us to Section 3, mortgage rates and scores. This is where it gets real. This is the high-stakes turning point, because this is where we see the actual, real-world dollar impact of those credit ranges. It brilliantly illustrates what we call the ladder effect. Basically, the higher you climb on that credit score ladder, the lower your interest rate becomes. Look at this comparison using data projected for 2026. Let's say a borrower with an excellent score of 760 secures an interest rate of 6.7%. But a borrower with a fair score of 620 gets hit with a rate of 7.36%. Now you might hear that and think, oh, that's barely a fraction of a percent. But on an average priced home, that tiny bump in interest translates to an extra $168 flying out of your pocket every single month. And if you stretch that $168 over the life of a standard 30-year mortgage, Having that lower FAIR score ends up costing the borrower over $60,000 more in interest. I mean, wow, that is a massive amount of money. This is exactly why improving your score by even just a few points can bump you into a cheaper rate tier and literally save you an absolute fortune.
Okay, I know that math can create a bit of tension, but take a breath. Section 4, strategies to improve scores. Don't panic about the numbers because we are going to get you a game plan. Here is a strategic playbook to empower your credit health right now, broken down into 3 totally actionable steps. Step 1 is the fast move. Pay down those credit card balances. Remember our cake analogy? Amounts owed is a huge slice. Keeping your credit use below 30% of your total limit is a massive win, and doing that can actually boost your score in just 30 to 60 days. Step 2 is the slow move. Pay every single bill on time every single time. Look, there's no magic shortcut here, but this has the absolute greatest long-term impact on your score. And step 3, check for errors. Did you know roughly 1 in 4 credit reports actually has a mistake on it? That's crazy. If you find a late payment listed that you know you paid on time, you can dispute it, and getting that fixed can help your score rebound super fast. Almost to the finish line. Section 5, common myths and tips. Now, what's really interesting here is just how many people still believe these misconceptions. So let's do a rapid-fire myth-busting session. Myth 1, checking your own score hurts it. False. Checking your own credit is what's called a soft pull, and it absolutely doesn't impact your score at all. Myth 2, there's a secret credit blacklist. False. There's no secret list. Lenders are just making their decisions based purely on the math. Myth 3, closing old accounts helps your score. Usually false. Remember that length of credit history factor? When you close an old account, you're shortening your history and making your total available credit look smaller, which can actually lower your score. And myth 4, your relationship status affects your score. False again. Your credit is yours alone. Getting married doesn't magically mash your 2 scores together. As you really start digging into your options, I want you to remember that even if your score isn't totally perfect yet, you absolutely still have paths forward. For example, FHA loans might actually allow for a credit score as low as 580 if you have a small down payment. And if you happen to be a veteran, VA loans often have no minimum score requirement from the government at all, though individual lenders might set their own rules. But listen to me. Here is my absolute biggest pro tip for the house hunt. Do not open new accounts. Once you actively start looking for a house, do not apply for new credit cards, do not buy a car on credit. Those actions create hard inquiries, which can temporarily drag your score down right at the exact moment you need it to be at its absolute highest. So the really crucial point I want you to walk away with is this. Giving yourself 6 to 12 months before you buy to build small, healthy habits is hands down the absolute best way to lower your future mortgage costs. Just keep our 3 big takeaways in mind. Number 1, your credit score is basically your entire financial reputation packed into a tiny 3-digit number. Number 2, a higher score means a cheaper mortgage and keeping way more of your hard-earned money in your pocket every month. And number 3, small, consistent habits, like paying down those balances and never missing a due date, make the absolute biggest difference over time. Buying a home is literally one of the biggest, most exciting milestones in your entire life. Yes, it can definitely feel a little overwhelming at first, but mastering this one 3-digit number is your fundamental first step toward making that dream a reality. So I'll leave you with this to think about. What is your financial GPA? And are you ready to take control of it today? Thank you so much for joining me on this explainer. Keep learning, and best of luck on your incredible journey to homeownership.